Something major is happening in global finance. The US dollar is collapsing, and it's hitting Americans where it hurts. The US dollar has plummeted 9% against the euro, and it's only July. But this goes bigger than the exchange rates. Global trust in the US's currency is eroding fast. But why is the dollar falling so rapidly? And why should you even care? Well, it turns out it matters much more than you think. Find out why on today's episode of the Infographic Show. Why the US dollar has fallen against the euro. And don't forget to subscribe. It's official, the dollar is in free fall. The US dollar is plunging against global currencies, and the impact is impossible to ignore. As of December 31st, 2024, $1 was equivalent to 0.966 euros. By June 10th, 2025, $1 can only buy 0.8747 euros. In practical terms, 1 euro now costs $1.14.3 instead of $1.04.1, making everything from travel to imports more expensive. That is a 9.8% surge in the euro's value. So what's going on, and why does it matter? At its core, it's all about confidence. When investors lose faith in a country's economic future, they move their money elsewhere looking for safer bets, or at least to try to diversify away from being overly tied to a certain currency. In this case, it means selling off dollar-based assets in favor of something like the euro. The result is dollars flooding the market, driving their value down. Meanwhile, rising demand for the euro pushes its value up. But why is this happening to the US in 2025? To answer that, we need to jump back to the previous year when the dollar was actually climbing in value. The US was leading one of the strongest post-pandemic economic recoveries globally. Wall Street responded positively to the 2024 election results, and the incoming administration was expected to push investment-friendly policies. Confidence was high, and the dollar reflected that, rising steadily through the end of that year. And then, in 2025, everything went haywire. It started with the US administration's proposed tariffs, sending shockwaves through the global markets. Now you might be thinking, wait, most of those tariffs didn't even happen, right? So why does it matter? Well, some of them did happen, maybe just not to the full extent originally threatened. The real turning point was the escalating trade tensions between the US and China. On February 4th, the US president announced 10% import tariffs on Chinese goods, and then on March 3rd, those tariffs doubled to 20%. Simultaneously, there were 25% tariffs added to imports from Canada and Mexico. However, a one-month pause was applied on March 5th, but tariffs between the US and China ended up hitting a peak of 145% on Chinese imports, which has fallen to 30% as of May 14, and a 125% Chinese retaliatory tariff on US imports, which has now fallen to 10% as of June 2025. These actions caused Bruce Cashman, JP Morgan's chief global economist, to say we see a materially higher risk of a global recession due to U.S. trade policy. And while many economists predict that U.S. tariffs and the ongoing trade war could lead to a worldwide economic contraction, they believe the U.S. will be hit the hardest. The IMF states that a universal 10% rise in U.S. tariffs, followed by retaliatory measures by the EU and China, would reduce global GDP by 0.5% and U.S. GDP by 1% through 2026. Predictions like these mean that investors are even more likely to switch from dollars to euros. They want to bet on an economy that they believe will be less affected by an escalation in the tariff war and resulting economic downturn. Unfortunately, the U.S. administration decided to double down and announced a minimum 10% tariff on all imports. There were even higher rates for almost 60 countries, including China, Japan, and the EU, which went into effect at the beginning of April. JP Morgan's chief U.S. economist, Michael Feroli, said that by our calculations, this takes the average effective tariff rate from around 10% to just over 23%. It's important to point out that these tariffs would raise $400 billion in revenue for the U.S. government. Unfortunately, they'll also make a lot of products pricier for U.S. consumers. And while any reduction of the deficit is great, it is not nearly enough to take care of the U.S.'s debt problem. A $400 billion gain amounts to just 1.3% of GDP and only 1.1% of the total U.S. debt. Meanwhile, proposed legislation continues to push spending higher, meaning the new revenue won't change much when it comes to the U.S. paying it off. Then on April 9th, the administration walked things back temporarily. It paused country-specific tariffs for 90 days, easing pressure on most trade partners except China. Even if the tariffs weren't as high or they didn't last as long as initially feared, the damage was done. Many remained paused, not reversed, but it is the instability that rattled the markets. Constant shifts in economic policy shake investor confidence, and with it, the dollar's value. Most investors, especially those investing in currencies, value stability. The democratic process of the most wealthy economies may seem frustratingly slow at times, but it gives investors faith in the market. Senior economist and director at Alliance Global Investors, Greg Meyer, said that rising tariffs are predicted to slow or stifle U.S. economic growth. So even just the threat of them is enough to shake confidence in the U.S. economy. While some tariffs were proposed and enacted back in 2018, the U.S. was in a much better position financially back then to be able to weather them. It hadn't gone through a global pandemic and subsequent stimulus package and carried significantly less debt than it does now. Meyer adds, this time the U.S. economy may have a little more trouble avoiding tariff whiplash than in 2018, during the administration's last trade war, as there is no longer the high fiscal stimulus that there was then. Not to mention, confidence in the U.S. dollar is not just a reflection of a country's current economic status, but also what investors believe are its future prospects. And the U.S.'s future, well, it's not looking as bright as it once was. In May of 2025, Moody's downgraded the U.S. credit rating from a top-notch to slightly less than stellar AAA to AA1 over concerns about its trillions and trillions of accumulating debt with no end in sight. As of June 2025, the U.S. holds $36.2 trillion in debt, or just over $106,000 for every person that lives within its borders. And a new bill currently trying to get passed through the Senate plans to add another $2.4 trillion to the deficit over the next decade, according to the Congressional Budget Office. That means that the downgrade from Moody's comes at one of the worst possible times, as the borrowing costs of the U.S. will increase due to its credit rating downgrade, making paying off the staggering U.S. debt even harder. While this may all seem like it's way above your pay grade, a decreased credit rating and higher borrowing costs affects everyday life as well. Douglas Bonaparte, president of Bonafide Wealth, shares, think higher rates on mortgages, credit cards, and personal loans, especially if confidence in U.S. credit weakens further. For everyday Americans, this is horrible news. Another factor putting downward pressure on the U.S. dollar is the fear of slower growth and higher inflation after the latter finally came under control in 2024. Federal Reserve Chair Jerome Powell, who is tied to the dollar's devaluation in more ways than one, as you'll soon see, said that the expectation of slow growth means that it'll be harder to lower the Fed's benchmark, which influences the interest rates banks charge consumers. And it's not just the Federal Reserve predicting a recession. A CNBC Fed survey of fund managers, strategists, and analysts revealed a sharp shift in opinion. In January 2025, only 23% predicted a recession within the year. By March, that number had jumped to 36%. There are a few factors driving that, but the top cause is by far tariffs. Senior industry analyst Ted Rossman said, economic uncertainty, especially regarding tariff policy, has the Fed and a lot of businesses on hold. ING strategist František Saborski emphasized that he is seeing investors worried about a looming recession and doesn't think the U.S. dollar and U.S. Treasuries are anywhere near out of the woods yet. In fact, Saborski thinks there will be even more sell-offs in the near future, decreasing the value of the dollar and increasing Treasury yields. What is most worrying, perhaps, is that in times of economic uncertainty, usually the opposite happens. After the 2008 recession caused by the financial crisis, the dollar's value went up, and Treasury yields went down as investors worldwide flocked to invest in one of the only assets considered safe in periods of economic meltdown. However, this time around, it seems that investors are sensing a recession on the horizon and moving away from U.S. dollars and Treasury bonds, which is a really distressing sign for U.S. economic futures and the global faith of investors in the strength and durability of the U.S. institutions. On the other hand, the euro has been earning increased investor confidence over the years since the last financial crisis. The European Central Bank has instituted more active bond buying programs for its member economies and propped up its weaker economies. Recently, Germany stated it would issue 1 trillion euros in government debt as a stimulus to boost the eurozone economy. As a result, investors are switching over from dollars to euros. According to Peter Kinsella, global head of Forex strategy at Union Bancaire Privée, the main catalyst is an apparent repatriation trade from European investors who are selling U.S.-denominated assets and repatriating capital to the eurozone. This flight of investment from the US dollar has not been helped by the US administration's statements against the Federal Reserve. The president has frequently and publicly pressured Jerome Powell, the chairman of the Federal Reserve, to resign, while also criticizing his character. Though this might seem like a run-of-the-mill political bickering, the independence of the Federal Reserve's chairman and the independence of central banks in general is really important to investors' view of a country's stability. The reason the Federal Reserve was made independent from the political administration is so that the bank could be run by seasoned economists and investors, and it should operate without pressure from the political trends and without being beholden to each new administration's political goals. Susanna Streeter, the head of money and markets at Hargreaves Lansdown, a financial services company, said the independence of central banks is seen as critical to ensure long-term price stability, ring-fencing policymakers from short-term political pressures. Even if Powell is not removed as chairman, Alliance GI senior portfolio manager Ranjiv Mann said that investors seeing the Fed as increasingly more politicized will shake confidence in U.S. economic policy anyway. This in turn would further devalue the dollar, and if things don't change, in the very long-term future risk its status as the world's reserve currency. The dollar replaced the British sterling as the world's reserve currency in the Bretton Woods Agreement of 1944. Since 2 world wars had decimated the UK economy and most of Europe, the US had the good fortune to be fighting World War II on not its land, meaning the war provided more of a boost to its economy through weapons manufacturing and related industries. In simple terms, being the world's reserve currency means that central banks around the world hold large reserves of US dollars and use them in international transactions. Half of world trade invoices are done in US dollars. In many cases, when foreign countries want to trade with each other, they use dollars as a kind of go-between currency. Let's say Japan wants to trade with Argentina. The Japanese will convert their yen to dollars, which they'll use to pay for the products from Argentina. The Argentinians will then convert those dollars back to Argentinian pesos. While the dollar was originally backed by gold, in 1971 President Nixon did away with the gold standard, which means that since then the dollar has been backed by U.S. government credit and faith in the U.S. continuing to be a politically stable economic superpower. And global trust in both things is fading fast. Ipsos conducted a poll in 29 countries in April 2025 and found some concerning trends when it comes to international opinions of the U.S. 26 out of 29 countries surveyed were less likely to say that the U.S. will have an overall positive influence on the world. In fact, international opinion of the U.S. is so low that it is the first time in a decade of this poll being conducted that China is seen as a more positive influence worldwide than the U.S. 49% of people surveyed said China will have a positive effect on world affairs, while only 46% of people said the same about the U.S. But that's just one poll, right? Well, the 2025 Democracy Perception Index agreed with those findings after surveying 110,000 people in 100 different countries. The hit to the U.S. international reputation was most pronounced in the Eurozone, perhaps explaining why so many European investors have decided to take their money elsewhere, back to Europe. Even more troublingly, Americans themselves don't seem to think of their country as the world's economic superpower anymore. According to a March 2025 Gallup poll, 56% of Americans believe that the U.S. had the #1 military in the world, but 26% of Americans believe the U.S. had the world's #1 economy. Now, the good news is, despite the countries of the world souring on the U.S. all at once, there's no obvious candidate to take over as a global reserve currency anytime soon. The ideal currency would have to be used by a pretty big economic power, be able to be circulated and printed relatively freely, and belong to a very stable and prosperous economy. China's leadership has made it clear that the yuan will not become such a currency as they impose strict limits on its usage. The euro would be the other obvious candidate, as it's used by 341 million people in 20 mostly stable, well-off countries as of 2024. But it still has a long way to go to gain the international trust the dollar has commanded. Long-term worries aside, what does a weaker dollar mean for Americans and the world at large today? The first thing it affects is Americans' ability to spend money abroad and vice versa. U.S. residents traveling abroad this year might find their travel budget doesn't take them as far as usual. On the other hand, tourism to the United States could increase. Europeans traveling abroad might find it to be a cheaper destination than in most other years thanks to the usual strength of the euro as compared to the dollar. But surely this won't impact you. You're more of a staycation type of person. Well, the value of the US dollar actually affects a lot of other things in your life that you may not be aware of. And let's start with some positives. A fall in the US dollar could actually end up delivering on one of the US administration's promises to bolster the manufacturing sector. If the dollar loses value compared to other currencies and stays low valued for a while, especially against the euro, US exports will become cheaper for the rest of the world. That means that other countries are more likely to buy US-made goods, and manufacturing could see an uptick because of that. However, if you live in the US and you want to buy goods from the rest of the world, well, that might become a bit of a problem. The value of imports increases as the value of the dollar decreases against other currencies. In 2024, the US imported $605.8 billion of goods from the European Union, out of $3.36 trillion total in imports. That's about 18% of the total goods imported from the EU, meaning a high-value euro is going to hurt a significant chunk of trade. Now, it is possible that US-made goods could make up a portion of that trade, but building up manufacturing and production systems to create new domestic goods takes time, so it won't happen overnight. Not to mention, a lot of the products imported from the EU are very crucial. Almost 120 billion euros of EU imports to the US are medicinal and pharmaceutical products. Another 160 billion euros are machinery and vehicles, and 45.5 billion euros in electronic and electrical equipment. All of those sectors will be affected, with the average US consumer paying a much higher price for the goods in question. And those are just the direct effects of the dollar's devaluation. Another upside exists, but mostly for US multinationals. Companies like McDonald's that make a huge chunk of their money abroad and then convert it back into US dollars, they would see higher earnings benefiting investors and shareholders in the short term. Select US-based multinational companies competing with firms outside of the US, companies like Procter & Gamble, whose biggest competitors are European-based Nestle and Unilever, benefit greatly from a weak dollar. It allows their products to sell for comparatively cheaper prices around the world, while they get to convert the stronger euro from European sales into way more dollars than before. One interesting commodity that will be highly affected in a net positive way for the rest of the world but negatively for the US is energy. Oil and gas are generally priced in US dollars in international markets. A decrease in the value of the dollar means countries that use other currencies to buy oil and gas will get it for significantly cheaper. In the case of the EU, for example, it's about 9% cheaper than usual at the moment. But even these benefits are subject to the extent and duration of the dollar's devaluation. Short term is one thing. If the dollar continues to slide, it'll be mostly bad news for everyone in the US. Senior economist Greg Meyer put it like this: if US institutions have become structurally less reliable, global capital should naturally move elsewhere. This would perhaps erode the USD's status as a global reserve currency. Not to mention, a continuously devaluing dollar would increase the effects of Moody's credit rating downgrade, as interest rates would need to be further pushed up to strengthen the currency again. That impacts the US consumer's ability to pay off credit card debt and get mortgages or any other kinds of loans. But this is only the beginning. More and more countries are turning their backs on America's currency. Find out why and why so many countries are abandoning the dollar. Or click this video instead.